Thank you for joining Mayor Brown's Global Financial Markets teleconference series. Today's call is one of our special edition COVID-19 update calls entitled COVID-19 Next Steps for PPP Borrowers, Navigating the Loan Forgiveness Process and Mitigating Enforcement Risk. My name is Mitzenmacher. I'm a partner in Mayor Brown's Washington, D.C. office and a member of the firm's Financial Services Regulatory and Enforcement Group. My practice involves providing regulatory compliance advice to companies that offer various consumer and small business financial products and services, as well as conducting regulatory due diligence reviews on behalf of investors in financial services companies and their assets. First, a couple of housekeeping items. As regular listeners will know, this call is being recorded. We will be emailing an audio link to all participants should you wish to listen to the teleconference again or forward it to your colleagues. In addition, the recording will also be available as a podcast on your preferred podcast platform. Since we will not have a Q&A session, please send your questions regarding today's topic by email to gfm@mayorbrown.com, and we will respond promptly. This is the same email address as on your invitation email. Joining me today is my colleague, Andrew Kugler. Andrew is a partner in Mayor Brown's Los Angeles office and a member of the firm's government practice group. He provides strategic advice on public policy and regulatory issues and has been counseling clients on the PPP program since its initial consideration in Congress. Andrew is also a former congressional staffer. For those of you joining to hear our colleague, Joanna Nicholas, note that she was unable to join today due to a conflict, but she is another Mayor Brown resource on PPP issues as well. With those brief introductions, we will now begin today's discussion. Andrew will provide an overview of the circumstances under which a PPP loan may be forgiven, in whole or in part, after which I will walk you through the basic process for filing a PPP forgiveness application. I will then discuss certain considerations for borrowers looking to assess and mitigate risk under the PPP, including the SBA's recent issuances regarding loan level reviews and limited safe harbors from enforcement. With that, I will hand the discussion over to Andrew.
Thank you, Eric, and good morning to everyone. As Eric mentioned, in this first part of the call, we're going to focus on what you can do to maximize your loan forgiveness now that you have the funds. But first, I just want to take a second to remind you about something pretty important, and that's that there is ongoing discussions in Congress right now to change the rules and provide you with more flexibility on forgiveness. We'll discuss some of those proposed changes today, but you need to remember that things can change and that it's critical that you monitor the program and any congressional action very closely. With that disclaimer out of the way, let's talk about the two factors that could impact your eligibility for forgiveness. The first is when you spend the money. You're no doubt already aware of the covered period for loan forgiveness. That's the 8 weeks after you receive your loan. Anything you spend on eligible expenses during those 8 weeks is forgivable. Anything you spend after those 8 weeks is repayable. But right off the bat, here's an area that you need to monitor really closely. A couple weeks ago, the House of Representatives passed the HEROES Act, which included a provision that would extend the covered period for PPP loans. The Senate's not expected to take up that specific piece of legislation, but there is growing momentum in Congress to extend the covered period beyond 8 weeks. The discussions are moving towards a covered period of between 18 and 24 weeks. If that happens, you won't have to spend the entire loan within the first week to maximize forgiveness. You'll have a lot more flexibility, so stay tuned. Just to be clear, though, as of today, the covered period is still the first 8 weeks after the loan is funded. So if there is no further congressional action, you'll need to spend the money within that 8 weeks to maximize your loan forgiveness. The second thing that can impact your forgiveness is what you spend the money on. There's 4 categories of forgivable expenses that can be grouped generally into payroll and non-payroll. Let's start with payroll. Any compensation you pay out in salary, wages, commissions, that's all payroll, with one important caveat. The amount of forgivable compensation for each employee is capped at $100,000 annualized. That works out to about $15,385 per employee over the 8-week covered period. If you have an employee who makes more than that, you can still seek forgiveness for them, but only up to $15,385. In addition to compensation, payroll includes vacation, parental, family, medical, and sick leave, separation payments, employee benefits like group health and retirement, and state and local taxes. Your employer portion of FICA will not be part of your forgivable payroll. I've had several clients ask if they can maximize their forgivable payroll by paying out things like hazard bonuses. The answer is now yes. As long as you don't exceed the $15,385 cap per employee, you can seek forgiveness for things like hazard bonuses. A few other things to note about payroll. First, you have some flexibility on when to start your covered period. You can either start on the day you receive the money, or if your payroll cycle is biweekly or more frequent, you can start on the first day of your next cycle. So, for example, if you receive the loan on May 28th in the middle of a payroll cycle, and your next cycle begins on June 8th, you can wait and start your covered period for payroll purposes until June 8th. This makes it a lot easier to document your forgivable payroll. A second point to remember is that forgivable payroll can include costs paid or incurred during the covered period. So what does that mean? For example, you can get forgiveness for paychecks that were mailed out during the covered period, even for work that was performed before the covered period began. The same goes for wages that are earned during the covered period but paid after it ends. As long as you make the payments on or before the next regular payroll date, those wages incurred during the covered period are still forgivable. One last thing to note about payroll. As of today, 75% of the forgiveness amount has to be payroll expenses. You'll notice I said as of today. Well, that's another area where things could change. Many businesses have been asking for more flexibility to spend more of their PPP funds on non-payroll items like rent to keep their businesses afloat. And the HEROES Act that was enacted by the House a couple weeks ago did just that, in fact. It completely removed the 75% payroll requirement. Now, there's no consensus in the Senate on this issue. So if this is something that's critical to your business, this may be the time to contact your senator or representative and express your opinion. Let's turn now to non-payroll expenses. There are essentially three buckets of forgivable non-payroll expenses. The first is interest payments on mortgages that were incurred prior to February 15th. Second, rent on leases that were in force as of February 15th. And lastly, utilities for services that began before February 15th. What is utilities? That includes electricity, gas, water, transportation, telephone, and internet. Like payroll, these non-payroll expenses paid or incurred during the covered period are forgivable. So, for example, say you get your PPP loan on June 1st. You can then pay any outstanding April and May rent and utility bills on June 2nd and still get forgiveness for those payments, even though those expenses were not technically incurred during the covered period. Also, like payroll, any non-payroll expenses that were incurred during the covered period and paid on or before the next regular billing date are forgivable. So you don't have to make partial payments during the middle of a billing period in order to seek forgiveness. Again, SBA is just trying to make it easier to document your forgivable expenses. Be aware, though, that while you can align your PPP payments with regular billing cycles, you can't seek forgiveness for advanced payments. So no prepaying future mortgage interest or rent to try to maximize the amount you're spending during the covered period. Now that we've discussed when and how you should spend the PPP money to maximize your loan forgiveness, let's spend a few minutes on reductions. There's two ways to incur a reduction to your loan forgiveness. There's layoffs and wage cuts. Let's start with layoffs. Here's how it works. You calculate your average number of FTEs during your covered period. You then compare that number against one of two reference periods, and you get to choose which one to use. The first option is February 15th to June 30th of 2019. The second option is January 1st to February 29th of 2020. Now, note for those seasonal employees out there, you have different reference periods that you should discuss with your counsel. So, after doing that comparison, if the average FTEs during your covered period are less than your chosen reference period, there's a proportional reduction to your forgiveness. So how does that work? If you have, say, for example, 10% fewer FTEs during your covered period, there's a 10% reduction to your forgiveness. One important qualification on how to calculate FTEs. So for PPP purposes, the SBA has now made clear that an FTE means an employee who works an average of 40 hours or more per week, but 40 is the maximum. So if you have an employee who works 50 hours a week, they are still counted as one FTE. For your part-time workers, you've got two choices. First, you can calculate the average number of hours that they worked. So, for example, if they work 30 hours a week during the covered period, they count as 3/4 of one FTE. Your second option is you can just simply count each part-time employee as a half FTE, or full-time equivalent. But you have to be consistent. You need to apply the same standard to all of your part-time employees. You can't switch back and forth. The other way you can incur a reduction to your forgiveness is wage cuts. For this one, the only employees who matter are those who made less than the annualized equivalent of $100,000 in any pay period in 2019. You don't have to worry about any employees who made more than that. And here's how that calculation works. It's a little bit different. For each employee, you're going to look at their reduced wages during the covered period. This analysis has to be done on an individualized employee basis, not in the aggregate. You then compare their reduced amount against the base wages that were paid to them between January 1st and March 31st of 2020. Any reductions that exceed 25% are subject to a dollar-for-dollar reduction to your loan forgiveness. Let's plug in some numbers to use an example. Let's say an employee made $1,000 per week between January 1st and March 31st, and that their wages were cut to $700 a week during the PPP covered period. That's a reduction of $300 per week, or 30%. The first 25% of that reduction, or $250, has no impact on your loan forgiveness. The amount above 25%, or in our example, the $50 per week, does have an impact. Over the 8-week covered period, that would work out to a total forgiveness reduction of $400 for that employee. There's a way out of these reductions, though. If your layoffs or wage cuts occurred between February 15th and April 26th, you can avoid the reduction to your loan forgiveness by reversing them by June 30th. So, for example, if you were forced to reduce your headcount from 100 FTEs to 80 FTEs, you can still avoid the 20% reduction to forgiveness by restoring the headcount to 100 FTEs by June 30th. This is yet another example, though, of an item that is under significant discussion in Congress. Many businesses that are not ready or able to reopen are asking for more flexibility to bring their employees back after June 30th. And the HEROES Act that was passed by the House a couple weeks ago does, in fact, move that deadline back to December 31st. It's not clear whether that change is going to be a part of legislation that the Senate takes up, so you need to monitor the issue closely as well, but there is a potential that it's going to change. A few other things to note on reductions. If you try to rehire an employee at the same salary and hours, and that employee refuses to come back, there's no reduction to your loan forgiveness. This is essentially the SBA's solution to the issue that some raised about employees refusing to return to work because they were making more on unemployment and stimulus checks. If this applies to you, you still need to document your efforts to rehire and the employee's refusal. You also need to inform the state unemployment insurance office of the employee's rejection within 30 days. Another thing to note is if an employee is fired for cause, voluntarily resigns, or voluntarily requests a reduced schedule, you won't be penalized. They will be counted the same as if they were still employed. And finally, as you know, any loan amounts that are not forgiven are repayable as a 2-year loan at 1% interest with payments deferred for 6 months. I'll close with a reminder to monitor the Treasury website, which is a great resource, and any legislation very closely. As we've seen over the last 2 months, this program is a moving target, and there's momentum in Congress right now to change the forgiveness standards in a way that could provide you more flexibility. The most likely change at this point is the extension to the covered period from 8 weeks to somewhere between 18 and 24 weeks, but there could be others, so keep a close eye on it. With that, I'll turn this over to my colleague, Eric, who's going to discuss PPP forgiveness application and the audit process and risks. Eric?
Hi. So you've obtained a loan, you understand the forgiveness standards, you believe you qualify for at least some forgiveness, and you want to pursue forgiveness. How do you do that? Well, the forgiveness process involves the submission of an application to your lender or servicer. The SBA issued its form application package last week and a rule structuring the forgiveness process on Friday. Before digging into those materials, let me begin with two caveats. First, while the SBA issued a form application package, many of the more operational aspects of the forgiveness process, for example, do I submit a hard copy application or use an electronic portal, will be controlled by your lender or servicer and therefore may vary across borrowers. Second, while the SBA has issued its initial rules and forms for the forgiveness process, it may issue new guidance at any time. These caveats likely will not surprise anyone with experience handling PPP applications, but are nevertheless important to remember as you go through the forgiveness process. In general, you should expect your lender or servicer to reach out to you to begin the process and provide procedural guidance on how it will be accepting forgiveness applications, or to provide that guidance through updates to the websites or portals that the lender has been using for other aspects of its PPP program implementation. Nothing in the SBA's rules requires that the lender be the first mover in this process, but our experience suggests that lenders are moving in that direction to ensure as smooth and efficient a forgiveness process as possible. The forgiveness application itself will involve four elements. The first two, a PPP loan forgiveness calculation form and PPP Schedule A, must be completed and returned to the lender, along with certain supporting documentation. The third, a PPP Schedule A worksheet, must be completed and retained by the borrower, along with other supporting documentation that we will discuss shortly. The fourth, a PPP borrower demographics form, may be completed and submitted to the lender at the borrower's discretion. The lender may accept PPP forgiveness applications on the SBA's form documentation or through its own electronic version of the application. So in either case, the substantive information and documentation required should be the same. The core of the forgiveness process is the set of forms and documents that must be submitted to the lender and on which the lender and/or SBA will base initial forgiveness decisions. The PPP loan forgiveness calculation form requires the borrower to provide basic information about the PPP loan and the borrower's business operations that are relevant to calculating forgiveness. The form also requires the borrower to provide several figures reflecting essentially the highest level intermediate steps in the calculation of a forgiveness amount and ultimately an identification of the requested forgiveness. A borrower is not required to request the maximum amount of forgiveness, and they can adjust their calculations if they wish to avoid requesting forgiveness for any particular expenses. The form ultimately provides a glimpse into the calculation process without requiring a step-by-step demonstration of the calculation. The companion schedule to the PPP forgiveness calculation form is PPP Schedule A. It requires the borrower enter certain information or calculations from the PPP Schedule A worksheet that provide increasingly granular information about the forgiveness calculation, including breakdowns of payroll costs and calculations related to reductions in forgiveness. To complete the PPP forgiveness calculation form, schedule, and worksheet, the borrower will have to compile various documents about its business operations. One set of documents will need to be submitted to the lender. That set includes documentation regarding payroll costs, including certain bank statements or third-party payroll reports. The set also includes documentation supporting the borrower's average number of FTEs in the relevant time period prior to the COVID-19 emergency and during the covered period for PPP loan forgiveness, as well as documentation supporting the borrower's non-payroll expenses in categories that may result in forgiveness. Another set of documents will need to be compiled and retained by the borrower, but not necessarily submitted as part of the application. That set includes documentation of individual employees' salaries, as well as documentation supporting certain aspects of the reduction in forgiveness for reductions in FTEs or reductions in employees' salaries. Using those documents, the borrower will complete the worksheet, schedule, and ultimately PPP loan forgiveness calculation form. and submit the required documents. While we don't have time to address every application field, we note that the SBA has provided guidance that, in certain cases, provides flexibility that may prove beneficial to some borrowers. This guidance has been provided either for administrative convenience or as a means of providing substantive benefits in line with the policy rationale for the PPP. Andrew has already mentioned several of these changes, including that borrowers with payroll cycles that are biweekly or more frequent may shift their cover period for forgiveness purposes to align with their payroll cycle, and that certain expenses incurred in the covered period may be included in the forgiveness calculations, even if they are paid slightly later. We would recommend that borrowers review PPP rules and guidance carefully to determine how fields should be completed in the borrower's particular circumstances. Once a completed application has been submitted, a borrower can expect to receive a decision on forgiveness within 60 days. Borrowers may receive either an approval, albeit potentially for an amount the lender has calculated that differs from the amount originally requested, or a denial. If a forgiveness request is denied in whole or in part, the borrower may, within 30 days, request the SBA review the determination. In some cases, a lender may notify the borrower that forgiveness has been denied without prejudice due to a pending SBA review of the borrower's loan file. Before moving on to discuss SBA loan level reviews and PPP risk, we note that somewhat separately from the borrower's forgiveness application process, the SBA has established a 90-day window for the administration to review lenders' forgiveness determinations. The 90-day window is relevant to when the lender should expect payment for forgiven loan principal and associated interest. It does not directly affect when the borrower will receive a decision on the forgiveness application or when the borrower's loan may be subject to a loan level review by the SBA. We now move on to a discussion of loan level reviews and PPP risk. The potential for loan forgiveness is, of course, a significant benefit for eligible PPP borrowers, but the opposite side of that coin is the potential for material penalties for program noncompliance. From the start, the PPP has been a complex program that has combined certain PPP-specific requirements derived from the CARES Act and subsequent SBA rules and guidance with certain normal course SBA 7A or business loan requirements. Within each of these sets of requirements, certain elements have been front and center, having, for example, their own certifications on the PPP application or now the PPP forgiveness application, whereas others have been built into the program with more subtlety, such as being incorporated by implication into the borrower's general certification as to program eligibility. And frankly, even those requirements that have been front and center in some sense have been subject to ambiguity or change over time, as the SBA has issued guidance, sometimes on a daily basis, or has amended the program rules midstream. Despite the ongoing ambiguity, borrowers are at least at risk of being held accountable for any deviation from program rules, whether the rule at issue relates to eligibility for the loan, eligibility for forgiveness, use of funds, or other aspects of the PPP. Potential penalties include denial of loan forgiveness, as well as the possibility for civil or in certain cases criminal enforcement of various claims related to false certifications or statements to the U.S. government or to banks in connection with a loan or a claim. Those are penalties that exist under U.S. statutes related to fraud against the government or fraud against banks or under the False Claims Act or possibly numerous other claims that an enterprising enforcement attorney could conjure up around the same basic set of facts involving false certifications in connection with the receipt of money from the U.S. government. On Friday, as the SBA issued its rulemaking structuring the forgiveness process, it also advanced discussion on the process it will use to oversee PPP compliance through loan-level reviews. While the SBA is not the only party that may review a PPP loan for compliance, it is arguably the most likely source of liability in connection with PPP loan and the most likely party to dig into the weeds of PPP compliance. For context, the SBA previously announced that all PPP loans over $2 million would be subject to a loan level review, and that other loans may be reviewed at the SBA's discretion. Friday's rules provide some structure to those reviews. The first point of note is that SBA reviews may be initiated at any time. In Friday's rule, the SBA emphasized that borrowers are required to retain PPP documentation for 6 years, and that lenders must also maintain PPP documentation for time periods set by the SBA or for federally regulated lenders by their prudential regulator. The rule provided a sense that the administration intends to conduct at least some loan-level reviews during the window between the borrower's submission of a forgiveness application and the SBA's payment to lenders in connection with that application, but borrowers may still be exposed to review and enforcement well after the forgiveness process concludes. When reviews do occur, they will typically start with outreach by the SBA to the relevant PPP lender with a request for documentation. Initial documentation may include, for example, the borrower's PPP application, forgiveness application, supporting documents for both executed notes and the lender's loan records. The SBA may then reach out for additional information, either to the lender or to the borrower directly. For reviews conducted through this process, as opposed to, for example, criminal investigations initiated separately, a borrower will be notified by its lender within 5 business days after the lender is notified by the SBA that a loan level review is underway. Based on Friday's rule, other borrower engagement with the review process seems likely to be limited unless the SBA requests additional documentation that isn't in the hands of the lender, such as the documentation that is part of the forgiveness process that a borrower must compile but not necessarily submit, or if the SBA reaches adverse findings. If the SBA reaches an adverse finding, the borrower will have 30 days after being notified of that finding to request that the SBA review the decision. And adverse findings may involve anything from ineligibility for the program overall to, frankly, relatively minor disputes over the calculation of a loan amount or a forgiveness amount. The SBA has also indicated that there will be an appeals process, so the administration will issue a separate rule addressing appeals at a later date. With respect to the types of issues that the SBA may review, Friday's issue expressly identifies the SBA's ineligible borrower types regulation, affiliation rule, and application certifications and representations as potential sources of adverse findings. But the SBA can look at any aspect of PPP compliance. Any determination of ineligibility for a loan will also render the borrower ineligible for any forgiveness. And while not technically a borrower issue, an ineligibility determination will also render the PPP lender ineligible for a processing fee in connection with the loan, creating a potential loss or damage to the lender in connection with an ineligible borrower obtaining or proceeding with a forgiveness application with respect to a PPP loan. The loan will still be 100% guaranteed even if the processing fee is not payable, provided the lender has satisfied its obligations in the origination and servicing of the loan pursuant to PPP rules. Among issues that may be considered by the SBA during a loan level review, the issue that has received the most headline attention to date has been the borrower's certification that current economic uncertainty made the PPP loan request necessary to support the borrower's ongoing operations. In connection with this certification, the SBA has made various non-binding statements about the types of entities it believes would be unlikely to qualify, such as large public companies. But it has also established a set of 3 safe harbors. Borrowers that applied for a loan prior to April 24th that returned all PPP funds by May 18th. Borrowers that, in aggregate with their affiliates, received PPP loans not exceeding $2 million. And any other borrower that repays PPP loan proceeds promptly upon an SBA determination through a loan level review or otherwise, the borrower did not meet the terms of the certification, will not face either SBA enforcement or the possibility that the SBA might refer the loan or the matter to another federal agency for enforcement. These safe harbors are limited to this particular certification and would not apply to any other claims, such as that the borrower is ineligible for reasons unrelated to the certification. They also would not apply to enforcement by any agency other than the SBA if that agency could and wanted to proceed on a claim without SBA referral, or to claims that may be brought by private litigants, such as False Claims Act suits initiated by private relators. So this is a limited safe harbor that addresses a specific certification in a specific way, meaning that the SBA itself will essentially waive its enforcement authority in certain cases. Other eligibility or certification items, such as how applicants should aggregate size across affiliates, whether applicants must count all employees or merely those primarily residing in the United States, and how applicants should assess eligibility under the SBA's ineligible borrower types regulation and guidance have also been subject to ongoing SBA rulemaking and guidance. The only other issue that has been the subject of a particular defense or safe harbor to date, however, has been that borrowers that applied prior to May 5th will not be held ineligible for a PPP loan based solely on guidance regarding how employees should be counted when the applicant has foreign affiliates, provided that the applicant in aggregate with its affiliates had not more than 500 employees whose principal residence was in the United States, and that PPP funds are not used to support non-U.S. workers or operations. As with the other safe harbors, borrowers wishing or needing to take advantage of this safe harbor should ensure that they can document satisfaction of the requirement. And we again note that the safe harbor only directly applies to SBA enforcement or referral to other federal agencies. With respect to all eligibility and program compliance issues, borrowers should consider the documents and information they have available to demonstrate compliance should the need arise. Understanding these issues, pulling together documents, understanding who within your organization has the information necessary to assess eligibility or compliance issues can make later reviews or audits go much more smoothly and ultimately result in much better outcomes for a borrower than processes that leave that documentation to the last minute. Given the way the SBA has implemented the PPP to date, there may also be new rules or guidance issued on a rolling basis. Accordingly, borrowers may also benefit from continued attention to the PPP resources websites maintained by the SBA and Treasury Department. In theory, both of those sites contain the same information, though they may be updated at slightly different intervals. And the SBA has, on a couple of occasions now, indicated that the state of the guidance that exists when a borrower takes a particular action, usually the submission of a PPP application, may be relevant to determining whether that borrower has complied with the program. That is to say that the state of the guidance that existed when you take an action defines your obligations under the program. With that, our time is at an end, and I want to say thank you to our audience for tuning in. Three brief reminders. First, you will receive an email with a link to the recording of today's call, and the recording will also be available as a podcast on your preferred podcast platform. Second, for more information on Mayer Brown's extensive resources in relation to COVID-19, please visit our new website, covid19.mayerbrown.com. Lastly, as mentioned before, if you have any questions related to today's content, please email them to gfn@mayerbrown.com. Thank you again for your participation. You may all now disconnect.